the articles I've written, one of my favorites was titled, "Your Revenue Model Sucks." Again, I want to view all of this from the perspective of a potential buyer. Not just because you're looking to sell soon, but because treating your company this way will both defend and grow your value. The buyer is going to look at your company and consider the sustainability of your earnings. The buyer is going to calculate the answer to the question, once the owner walks out the door, how likely are revenues to continue? And how consistently? The more recurring your revenue, the more predictable your cash flow, the less risky you are, and the more a business is worth. I want you to be open-minded to the idea of creating recurring revenue. Providing your customers with a recurring transaction method they prefer can be a game changer for your business with relatively little effort. It takes a lot of bravery to embrace the change, but little effort. Let's review the types of revenue that are out there. There's consumables. An example of a consumable would be a coffee shop where revenue is all transaction based and most of those sales are based on the proximity of the customer to the shop. There's sunk money consumables. Keeping with a coffee shop example, Keurig machines have become very popular. A Keurig machine uses pods filled with ground coffee to make 1 cup at a time as opposed to a whole pot. The buyer of a Keurig machine is someone who's sunk money into the machine and they're more likely to continue buying those pods. And then there are subscriptions. Every year I get a renewal notice from my local fitness center. I must make an active decision at that point if I want to recommit, or if I haven't been going, it's easy to just not sign up and not pay the $500 a year again, since I haven't seen the value. And then there's sunk money subscriptions. If I cancel the membership at the fitness center, I can still use my at-home Peloton stationary bicycle. I bought the Peloton bike, but if I want to use the bike's live stream instruction classes, I've got to pay a subscription. In this model, I buy or sink money into the bike, just like I did the Keurig machine. But in this instance, I have an evergreen subscription. I don't have to make an active decision to buy a spinning class. There's also auto-renewal. Sticking with the exercise concept, there's another gym in this area that has done exceedingly well because instead of asking for $500 up front for a yearly membership, they ask for $0 down and just $10 per month. That's a much more affordable option. So more people sign up, including first-timers who start their New Year's resolutions but never come back. But the real value to the gym is not just the number of members on its list, but the auto-renewal payments. You just keep paying $10 a month whether you go or not, and you don't get a reminder to cancel. A lot of people don't go, but it's only $10 per month, so they never cancel. That's a lifetime of $10 per month revenue, which is very predictable due to a very low attrition rate. Finally, there's contracts. And contracts are a written obligation. It's ironclad, and that's the most valuable kind of recurring revenue. All firms can create recurring revenue. This makes sales less lumpy, improves predictability of cash flow, increases income, and makes it less stressful to run the business. Plus, you become more attractive to buyers. More importantly, your customers know and prefer these methods of payment. Every day you pick up the Wall Street Journal and read about a new way in industry, your industry is being disrupted by a large national player. Often technology is blamed, but that's misplaced blame. Technology isn't the disruptor. Technology is simply making it easier for the customer to do business with your competition because it's giving them the payment options they prefer. Think about your newest and biggest national competition. Now compare how they are charging customers versus the way you are charging customers.